The issue we wanted to address today is why interest rates in China aren't much lower. For a few months now, we've been arguing that interest rates in China would indeed be falling. We see nothing yet in terms of fundamentals to think it is necessary to change this view. Indeed, the deflationary trends that are becoming more evident by the day only reinforce our conviction that rates will indeed fall. Our model for the PBC's reaction function continues to suggest that the economic fundamentals are bad enough to keep the central bank deeply in cutting territory. That's shown by this chart, which shows our measure of the probability of policy change plotted against actual policy cycles, with tightening periods shaded red and loosenings shown in green. However, while the central bank in recent months has indeed been easing, our expectation that rates would fall in terms of market rates hasn't really played out. Rates haven't fallen much in recent months. Indeed, these days, market rates in China don't seem to move around very much at all. Just look at what's happened over the course of the last few months. The economy experienced unprecedented recessions during most of 2022. Then, there was a sharp and largely unanticipated recovery from the fourth quarter of last year. More recently, the economy has been slowing down once again. And yet, despite all of this macro volatility, 5-year CGBs are now yielding 2.4%, which is the same as August 2022 and in the January before that. The trading range during all of this time has been just 30 basis points. So, on our assessment, rates should be falling, but the market obviously seems to disagree. One explanation for this disconnect is the type of loosening that the central bank has been pursuing. The PBC is loosening, but only slowly, with total cuts of only around 15 basis points since 2022. The outgoing PBC governor, Yi Gang, has explained this incrementalism as a deliberate so-called attenuation strategy. More broadly, officials in Beijing have used this caution to reinforce their claims of a sound and sensible policy, and in particular contrasting that with what they say is the recklessness of the Fed and central banks in other advanced economies. Now, if it's the PBC's sort of policy loosening that the PBC is doing is the main explanation for market rates, it seems somewhat risky. With the economy so weak, the lack of more aggressive easing risks a policy mistake, with the central bank being behind the curve. If that's right, it implies the economy will weaken further from here, which in turn brings the likelihood of bigger rate cuts somewhere down the line. We do think that the nature of PBC easing must be part of the explanation for the stability of market rates, but it's probably not all of it. Another part of the puzzle is likely that the bond market simply doesn't reflect fundamentals in China. In talking about the attenuation strategy, Yi Gang recently also once again brought up the second pillar of his policy approach. That's the so-called golden rule, by which the bank tries to ensure that actual real interest rates are roughly in line with potential GDP growth. Now, in theory, this seems like quite an ideal approach, but obviously implementing it in practice is much more difficult. Particularly when inflation is so weak, the PBC can't say for certain where real interest rates actually are. We think that the surge in time deposits in particular shows that real interest rates are actually rising. Assessing potential GDP is even more difficult. Moreover, if this is the aim, then even the data presented by Yi Gang himself show that it's only in very recent years that has even roughly been achieved. The reality is that it is difficult in China to find an economic indicator that serves as a reliable anchor for yields. Now, this all said, it is still true that growth has been trending down in recent years, and so have rates. And so, if nominal activity does continue to slow, then ultimately rates should fall further. This gets to a third explanation as to why rates haven't played ball. The economy isn't as weak as we think, and the market is pricing in a better economic outlook. Perhaps the markets think that more forceful policy help will be arriving soon, and obviously that's been the market chatter this week. Or maybe there is some agreement with what seems to be the government's view, that restructuring of the economy away from real estate will ensure productivity growth holds up, meaning that potential growth is high enough to keep even rising real interest rates quite accommodative for the cycle. There is the risk of a new cyclical policy push, and it would be a big deal if that included central government borrowing to finance household spending, something which hasn't happened in the past. In the short term, it is this that seems like the bigger risk, rather than evidence emerging of an economy-wide rise in productivity. And without more meaningful stimulus in the short term, we'd still come back to our starting point, that we think that interest rates still have further to fall. Now, if you are interested in macro markets in China, Japan, Korea or Taiwan, please check out our website at eastasiaecon.com. There you can sign up for our coverage of cycle and structural developments across the region, find a large number of live curated charts, and also a data portal. Again, that's all at eastasiaecon.com. Thanks very much.